Please welcome to the stage Bloomberg Intelligence U.S. media analyst Geetha Ranganathan.
Hello, everyone. My name is Geetha Ranganathan. I am a media analyst for Bloomberg Intelligence. Been covering the sector now for about 12, 13 years. And kind of in keeping with the topic du jour, I'm also going to be talking about trends in media. But we're going to look at, the past, the present, and the future of media more from a financial lens. So before we get into that, just a little bit about my group, Bloomberg Intelligence, or BI. So BI is basically the in-house research department of Bloomberg. And we take a very data-intensive, kind of multidimensional approach to investment research. So what we try to do is really kind of offer our clients insights from many different perspectives, whether it's equity, credit, government, litigation, regulation, ESG. We kind of try to do it all. It's a pretty big group. We have 400 research analysts across the globe. And what I'm going to try and do today is show you a lot of the data, the charts, all the other cool stuff that we compile at Bloomberg Intelligence. So, I like to start out with this chart because, of course, we want to know where we're going, but it's also interesting to kind of take a step back and see where we've been, right? And if you kind of think about what has happened in the media industry over the past few years, I think the most striking, the most powerful trend really here is digital disruption. And I think this chart kind of really captures that very, very perfectly. So what you see here is a snapshot of the market capitalizations of some of the largest media and tech companies in the world. We're comparing them today to what they were 10 years ago. And you can kind of see digital disruption in play here, right? So Alphabet and Facebook's Meta basically are dwarfing the rest of the competition. As they say in advertising, the golden rule is dollars always follow eyeballs, right? And so you can kind of see that at play here. And, let's just drill a little bit more into the global ad space. So this is really an $800 billion ad industry, worldwide. And this line chart basically just captures ad spending on different platforms. So the white line that you see there obviously is digital. It's been growing at a really fast pace. It's been taking share from all of the traditional media, the TV, the radio. It's obliterated certain sectors like newspaper and print. And if you kind of just think about, digital, about 10 years ago, digital made up about 25% of the global ad market. Next year, it will be 75%. So there's absolutely no doubt that digital dominates the ad space. And then if you look within digital, you have Facebook and Google, which are obviously the most dominant players. But along with them, we also have Amazon, which has kind of recently joined that. And the three of them control about 70 to 75% of all the ad dollars that are transacted in the world. So, obviously, Google and Facebook, the big disruptors. But let's look a little bit on the other side, right? Who's been disrupted here? So one of the big victims, of course, has been, the television ecosystem. And if you kind of think of the bedrock of the television ecosystem, it is the pay TV bundle, right? That bundle of 200 or 300 channels that all of us paid for, but nobody really watched. And if you kind of think about the pay TV bundle, it's pretty much been unbundled at this point, well, thanks to cord cutting. And so this chart kind of tracks for you the number of pay TV households in the US. So in 2015, we had about over 100 million households. Fast forward next year, we might have just about 66 million. So effectively, a third of the subscriber base has been wiped out. And what's really interesting here is Netflix in the US will have more subscribers than the pay TV universe. Let's take that out a couple more years. We could very soon be looking at a pay TV universe with less than 50 million subscriptions, let's say if ESPN decides to go all into streaming. So it's a pretty scary time. And it really has some very important financial ramifications for the companies that operate in this space. You think of, TV network owners, whether it's a Paramount or a Fox or a Disney. I mean, the pay TV bundle is their bread and butter, right? Because advertising, again, you need subscribers for viewership. You have lower ratings, lower ad dollars. And then, of course, affiliate fees, which is the programming fees that they kind of charge. Again, that's calculated on a per subscriber basis. So the fewer subscribers you have, again, lower revenue. So digital disruption, the rise of Netflix, all of this has kind of taken a big bite out of the top line of these media companies. So, where have these subscribers gone? Well, a lot of them obviously have gone to streaming. So this is Nielsen data, which kind of just tracks viewership. And 40% of TV viewing today is happening on streaming. So that's larger than broadcast, that's larger than cable. And just as the pay TV bundle has kind of been bleeding subscribers, you know, all of these other services, whether it's a Disney Plus or a Hulu or a Netflix or an Amazon, they've been slowly kind of building up their subscriber bases. But just hold that thought for a minute on subscribers, because, you know, for the longest time, we know about the streaming wars. Everybody was kind of fighting tooth and nail, trying to get that new subscriber, you know, trying to become the next Netflix, right? But something happened last year, right? Plot twist. Netflix, for the first time in their history, you know, reported the slowest growth in subscriptions. And this kind of really triggered not just a meltdown in Netflix stock, but it also triggered fears across the landscape that a streaming slowdown was coming. So we're seeing you know, you can see the chart there. Obviously, there's been a drastic slowdown in the number of streaming subscriptions. In fact, not only are we seeing lower subscriber growth, we're seeing some of these services have pretty high churn. So Disney Plus actually might lose about 17 million subscribers this year. And just overall, if you look at the overall landscape, we're going to see 75% fewer subscribers added to streaming platforms versus last year. So that's a pretty bleak outlook, right? Well, it turns out that Wall Street really doesn't care anymore about subscriber growth. The new metric that they care about is profit. So why are we suddenly talking about profits in the streaming world? Well, we're talking about it because it doesn't exist, right? With the exception of Netflix, nobody in streaming today is making money. Big media, and some of the companies are listed there, Disney, Paramount, all of them collectively lost $10 billion last year on their streaming initiatives. They're going to lose another $8.5 billion this year. So then that begs the question, can streaming ever be a good business? Well, you know, we'll get to that in a minute, but first we need to see why we even got here, right? We got here because all of these companies overspent on content. We know that content is king. We know content can be a real differentiator. Everybody wanted the biggest, the best, the buzziest, the largest, the greatest show on their service, and so they went and they overspent. You know, they paid hand over fist for that great show. And what happened then was the streaming wars effectively turned into the spending wars. And you have the streaming services this year spending in excess of $72 billion just for their content, okay? So that's a lot of money. And if you kind of think about that just in terms of show costs, right? If you looked at a good quality show about maybe 4, 5, 6 years ago, the average cost per episode was roughly about $3 to $4 million. That today is easily about 15 to 20 million for a lot of these shows. And you can see some of these services have paid astronomical sums of money, right? You know, 58 million there for Lord of the Rings. So content costs have really kind of skyrocketed. So then we come back to the question, can streaming be a good business? Well, it can be. You know, it is doable. It's hard, but it's doable because Netflix has shown us that it can be a good business. So let's just walk through some math here, okay? So how does Netflix make money? Of course, through subscriptions. You and I pay roughly about $15, $16 per month here in the US. Overseas, it's a little bit lower. So on average, Netflix is collecting about $12 per month per subscriber. Now, they spend about $5 per month on content, about $4.5 on marketing, other, you know, expenses, UI, better tech, so on and so forth. So total cost per month to Netflix is about $9.5 for a subscriber like you and me. So that just leaves them with profits of about $2 and change. You kind of multiply that over their subscriber base, 240 million, 12 months a year. So we land up with about $6.5 billion in profit every year, or at least this year. And the idea is that, you know, they are going to build this long-term model where they can basically increase revenue, lower costs, and you have earnings that is sustainable and that's growing nicely. And Netflix will actually do that. So Bloomberg Intelligence thinks that by 2026, Netflix will be the most profitable media company in terms of operating margins. But again, we got to take a step back and see how exactly Netflix has done this, right? Netflix has done this because they have scale. They have 240 million subscribers. They have fixed content costs that can be spread over that large subscriber base. In contrast, think of a service like Peacock, right? Peacock has 1/10 the subscribers that Netflix has, and so their content costs are about $18 per month, right? But again, the mandate is pretty clear for all of these streaming services. They need to make money. How are they going to do that? Well, there's not a lot of subscriber growth that is left. But there are a few levers that they can pull. So they can all increase prices, and everybody's been jacking up prices. Disney Plus is, you know, 30 to 40, I think 30% price increase goes into effect today. And it's not just price increases. They're doing all different things, right? They are cracking down on password sharing. They're introducing advertising. So we know that Amazon is now going to be introducing ads, kind of following in the footsteps of Netflix and Disney+. So we know that they can increase revenue, but we also know that they have to lower costs, right? And so we talked about the $72 billion in streaming costs. We talked about the cost of a television show. I also wanted to show you some data on the cost of producing an average blockbuster today. So that is at least $200 million. It is twice of what it used to be back in the 2000s. And let's just look at how, those costs can kind of get divvied up. So crew and production is about 40%. Post-production is about 30%. And as, kind of studios and executives look at lowering costs, I mean, if some of you were here last night, we heard Donna Langley from Universal kind of talking about taking down budgets a little bit, potentially for, the Fast and Furious franchise. And so this is where, they can probably look to kind of cut some of those labor costs to save a little bit. So post-production is definitely one area. And I'm kind of going to use the forbidden word here because Gen AI really can present some use cases where they can go and, cut down a little bit on those costs. Just going to touch finally on the box office because this is an industry that has kind of really bounced back very nicely after the pandemic. Not fully. We're still running about 20% below pre-pandemic levels. And of course, there is the overhang of the threat of the strikes. But despite all of that, I think there's quite a few positives that I'd like to highlight. So of course, we all know about the big Taylor Swift movie, promising to be a blowout this weekend. We also have big tech. So think of Amazon and Apple. They're really kind of committing sizable budgets to the theatrical experience. So Apple, in fact, is releasing Killers of the Flower Moon next weekend. But I think most importantly is the fact that studios are now kind of recognizing the power of theatrical for kind of building that word of mouth for generating profits. And so they've kind of committed to an exclusive theatrical window as well. So my time is up. So thank you all for listening to me. But the one thought that I want to leave you all with is, change is obviously a constant. Disruption is inevitable. Bob Iger said the riskiest thing that we can do is maintain the status quo. So, we can obviously expect a lot more innovation, a lot more change, and for certain, a lot more disruption. Thank you all. Hope you have a lot of fun.